WeWork didn't collapse because Adam Neumann was reckless. It collapsed because its entire growth engine was a bet that the next funding round would always arrive faster than the leases it had already signed came due. For 9 years, that bet paid off. Then, in the fall of 2019, one class of investor finally refused to make it. This isn't a story about a founder losing his mind. It's a story about a mechanism that was never built to survive scrutiny, and it was broken from the very first lease it signed. Most people already know this version. WeWork starts in 2010 in a single building in Soho. By 2019, it's valued at $47 billion, more than Ford, more than most airlines. It's raised over $10 billion, largely from SoftBank. It calls itself a tech company. Its founder talks about elevating the world's consciousness while renting desks. Then the company files to go public. The IPO prospectus becomes public for the first time, and within 6 weeks, the $47 billion valuation is gone, the IPO is pulled, the founder is out, and SoftBank is stepping in with a rescue package. 4 years later, WeWork files for Chapter 11 bankruptcy. The story that gets told about this is almost always a story about one man, his eccentricity, his spending, his control over the board. That story isn't wrong, but it's incomplete. It explains who let the company get this far. It doesn't explain what the company actually was. That's what we're going to look at instead. Strip away the founder and the branding and the actual structure underneath surfaces. At its core, WeWork did one thing. It signed long term leases with landlords at rates landlords were willing to lower in exchange for stability, and then it re rented that same space short term to freelancers and companies who'd pay a premium for flexibility. That's not a new idea. Traditional office sharing companies had been doing it for decades. WeWork didn't invent this trade, it just did it at a scale nobody had tried before. This trade itself isn't the problem. It's not even unique to WeWork. A company called Regus, now IWG, has run this exact same long lease, short sublease arbitrage since the 1990s. It's still operating today as the largest flexible office provider in the world. If the trade itself were the flaw, Regus wouldn't have survived 4 decades of recessions to prove otherwise. So the failure isn't the trade, it's everything WeWork built on top of it. This is where it gets structural. WeWork's own IPO filing shows the company was signing leases with landlords averaging roughly 15 years. Its own customers, meanwhile, were signing membership agreements averaging around 15 months. That's a 12-fold gap between how long WeWork was on the hook for space and how long anyone was actually committed to paying for it. Run that forward. If members leave during a downturn, a recession, a pandemic, anything, WeWork's revenue can disappear within a year. The lease obligations funding that space don't disappear. They're locked in for over a decade. Then comes the part that made this arbitrage look like something else entirely. WeWork didn't present itself to investors as a real estate company running a spread trade. It presented itself as a technology platform, a story that justified being valued like a scaling software company instead of a landlord. Real estate companies get valued on assets, rental income, and occupancy. Tech platforms get valued on growth potential. WeWork wanted the second valuation model applied to the first kind of business. This is the actual engine. Venture capital comes in. That capital gets used to sign more leases and open more locations. By mid 2019, WeWork's own S1 put the footprint at over 528 locations across 111 cities in 29 countries. That expanding footprint becomes the evidence used to raise the next round of capital at a higher valuation. More capital funds more leases. More leases fund more growth. The loop doesn't require the underlying spread trade to be profitable. It only requires investors to keep believing the next round will be bigger than the leases already signed. That's the mechanism, not founder spends recklessly, a financing loop that only functions as long as belief outruns liability. For years, most of this stayed largely invisible on paper. A new accounting rule, ASC 842, changed that. It required companies to bring operating leases, even the shorter ones that used to stay off the balance sheet, onto their books. When WeWork filed its S1 under this new standard, the number that came out was $47.2 billion dollars in future lease payment obligations. Not a rumor, not an estimate, a disclosed, audited figure sitting right next to a $47 billion valuation built almost entirely on growth narrative. To keep the story intact, WeWork introduced its own invented profitability metric, community adjusted EBITDA, where a standard adjusted earnings figure strips out interest, taxes, depreciation, and amortization. WeWork's version also stripped out costs like marketing and general administrative expenses, the ordinary cost of running the business. It was a metric engineered for one purpose: to make an unprofitable spread trade look like a scaling platform business. For most of the 2000s, this loop simply worked, and it's worth being honest about why, instead of treating the whole run as a fluke. Private investors were, in effect, betting on velocity, that WeWork's ability to raise money and expand its footprint would keep outrunning the slow moving lease liabilities stacking up underneath it. As long as each funding round was bigger than the last, the mismatch between 15-year leases and 15-month members never had to be tested. The company was also trying to make itself more durable, not just bigger. Between 2017 and 2019, the share of WeWork's membership base, made up of large enterprise clients, organizations with 500 plus employees, doubled from 20% to 40%. Enterprise clients typically sign longer, steadier commitments than freelancers. On paper, that shift should have made the mismatch between leases and memberships less dangerous over time, not more. As enterprise members grew from 20% to 40% of the base, WeWork's own average commitment term moved from about 8 months in December 2017 to 15 months by mid 2019 to roughly 22 months 2 years after that. That's real movement. It's also nowhere close to enough. The leases WeWork was signing with landlords were still running 15 to 20 years, the exact same span they'd always run. Stretching the customer side from 8 months to 22 months doesn't close a 15-year gap. It barely dents it, and it gets worse, not better, when you notice what was happening at the same time. While the enterprise shift was supposedly stabilizing the revenue side, WeWork was simultaneously signing leases to expand into as many as 169 additional cities. The company wasn't slowing down to let its more durable customer base catch up to its liabilities. It kept accelerating the liability side just as fast, sometimes faster. So this wasn't de-risking. It was the same bet, dressed in a more reassuring word. Enterprise sounded like stability. The math says it was still the same 15-year problem, just moving a little slower. The loop didn't break because a board finally grew a spine, or because one founder finally pushed too far. It broke because the company moved from a market that would tolerate the story to one that wouldn't. Private funding rounds are negotiated. The people writing the checks can choose to weigh the narrative over the numbers, especially when they're also invested in the last round being validated. Going public removes that discretion. The S1 is a disclosure document. The $47.2 billion figure isn't a talking point to be managed, it's a legal filing sitting on the same page as the growth story. Public market investors and the analysts and journalists reading alongside them treated the numbers as the story. Once that happened, there was nothing underneath the narrative to fall back on. Adam Neumann's related party dealings, his control over the board, his spending, all of that was real, and all of it made the company more fragile at the exact moment it needed to look most disciplined. But those were accelerants on a structure that was already unstable. The mechanism didn't fail because of the founder. The founder's behavior simply removed the last reason for anyone to keep extending trust to a mechanism that was already running on borrowed time. People ask if a more disciplined founder could have saved this. Well, someone else already tried something similar. Regus, the same company running the same lease arbitrage trade we mentioned earlier, filed for US Chapter 11 bankruptcy in 2003. No eccentric founder, no elevate the world's consciousness branding, no related party real estate deals, just an ordinary economic downturn, the dot-com bust, hitting occupancy rates while the long leases stayed fixed. The exact same structural mismatch broke a boring, disciplined operator with zero Neumann style theatrics. So the mismatch itself isn't something better leadership erases. That risk is structural. It was always going to break under the wrong conditions for anyone running it at scale. What discipline actually changes is how much the break costs you. Regus rebuilt after 2003 and came back with real insulation. It restructured most of its individual locations as separate legal entities, so the parent company generally wasn't the guarantor of any single site's lease. A downturn could take out dozens of locations without threatening the whole business, which is exactly what happened again in 2020 when Regus put nearly 90 individual locations into Chapter 11 during COVID without the parent company collapsing. WeWork never built that firewall. It couldn't really. The entire financing loop depended on centralized, continuous expansion to keep the growth story alive. Isolating risk location by location would have meant slowing down, and slowing down would have broken the narrative the whole valuation was built on. So, no, a more careful founder probably couldn't have made the 15-year mismatch disappear, but a more careful founder might have built the same insulation the company that had already been burned by this exact model was forced to build. WeWork didn't just inherit the structural risk everyone in this trade carries, it refused every safeguard the industry had already learned the hard way that it needed. The question isn't, is this company growing? It's, what is actually funding that growth? And what happens the day someone with no incentive to believe the story is forced to look at the numbers underneath it?